Welcome back, everyone, to Lem's Cryptoverse. So today we're going to discuss tokenomics, one of the most vital areas of crypto analysis. So remember, this is NFA. It's not financial advice. I'm here to educate you. And if you like this, please subscribe to us and smash that like button. Again, this is tokenomics, one of the vital areas to spend your time on in terms of analyzing crypto projects. So crypto projects must be, I've said this a million times, but it's very important to say it again, they must be analyzed like a three-legged stool. I keep saying the word holistic, and it's very important. So when I say holistic, I mean look at everything, and I don't just mean what I mentioned here. It's everything within the factors. So it's look at the top line holistically, and then at each individual factor holistically. So let's get started here. So take a look at the macro factors. Where are interest rates headed? Fundamentals, and that's the subject of today's presentation on tokenomics. And number three, look at the technicals. A lot of fundamentalists, especially fundamentalists, it sounds religious, doesn't it? A lot of people that look at investments are fundamentalists, but they don't spend time to look at the technicals. I think you need to look at both. And they say technical analysis is like astrology for men. I don't know. I think it works. I've seen it work. So try to use all three of what I just listed here. So I'm going to go through this presentation rapidly. So what you could do is stop and print because there's a lot to talk about. Okay, this slide here explains what tokenomics is. And I said earlier, you can print this out at your free time and highlight what's important. So I'm going to deep dive into some of these in the next few minutes, but I'm just going to breeze over some of them quickly. Tokenomics are factors or attributes that affect the supply and demand or value of a particular crypto project. And here's some of the major factors. Not all, but I think I covered most of them. Is there a maximum supply limit? Or is there no limit on how much they could issue, like the US government? What's the circulating supply compared to max supply? What's the vesting schedule? We're going to talk about that. What's the distribution of the ICO? Are the whales that own a lot of the coins, or is it the foundation? Is it the venture capitalist? What's the inflation on it? What's the utility of the coin? Is it just a meme coin? It's just used for fun. You like the coin, it looks like a dog. Or does it have actual utility? And what's the potential demand for that? The adoption curve? What's the control by insiders? And this is a little different from the whales. Like, point for this is that they're on-chain or off-chain governance. And if it's on-chain, is it really on-chain, or is it like the old federal system where the elite really had the control, even though it's on-chain? And then lastly, what's the stake supply and how many days is it locked in for? Again, I'm going to talk about this in the presentation for some of the key factors. Okay, before we get started, tokenomics, you can compare this to a corporate shares, like a stock, like Apple Computer or IBM. We all know that Apple Computer and IBM are always talking about buybacks. It's always buybacks and buybacks. Why? Because these are mature companies, have a lot of cash flow, and some people, I hate to say, feel that there may not be any growth left in these companies, even in Apple, even though IBM actually, both Apple and IBM are computer companies, tech companies, there should be growth. But you know what? It's a lot slower than it used to be, so people want their money back. So my main point here is that share buybacks are a smaller factor for corporations in general, unless you're talking about a recent IPO. Like, most people, investors, are looking for what's going on with the company, how's their revenue growth, what's their total addressable market, what's the use case like for their product, are they selling well, are they selling a lot of widgets, is there demand for those widgets? That's what people are looking for. They're looking at the quarterly earnings reports, but not for crypto projects. Tokenomics is one of the most important factors for crypto analysis. That's the most important thing you should get out of this slide. Okay, let's get started. Let's look at some examples. Factors affecting tokenomics. As I mentioned earlier, having a max supply is very good, but it's not always a case where it's very good. If you have a max supply, it's very good, but it implies that your circulating supply is somewhat close to your max supply. So when I say somewhat close, you want it to be over 60%, and here I wrote 75%. So this is a case of Pyth network or Pyth network, whatever you want to call it. This is the second largest oracle. It's a very hot oracle. It's a very hot project because it's on the Solana blockchain network, and everyone's going gaga, including myself actually, over Solana. But in this case, you could see that maybe Solana is good, but Pyth network is not that good, because if you can see here that the circulating supply is 1.5 billion, which is high in and of itself, but the total supply is $10 billion. So that's a huge amount of dilution and inflation that's going to be happening in the future. So I'm not a big fan. I like Pyth network in terms of use case and things like that. It's an oracle, it's needed. But in terms of tokenomics, no bueno. It's very bad. Okay, here's another example. This is whale risk, insider risk. So in terms of whales, I wrote in the first point, are there whales? Are there large holders that can dump on the market? And this is a very good chart I've seen many times. People present this chart. This is from Asari. And they haven't done this in a while. They did this a few years ago. And this chart here shows you, or divides, I should say, all the ICOs in terms of what the amount of ICO that was on public sale, and we want high amount of public sale. What percentage was a community allocation? What percentage was insiders? And that's in that pinkish color, that Nantucket red, I guess you should say. And what's in the foundation? So I think we all know about the pink, the insiders. If it's a lot of insiders, that's well risk, that's bad. They could dump. But what people don't know about are foundations. Foundations tend to be good, right? Because they're holding all those coins, and it means they have a lot of money, right? They have a lot of probably the native coin that they can spend on, and they could fund themselves. They can fund the developers. That's a good thing. But what the foundations could also do, if they have most of the money, their treasury in their native currency, they can dump those currencies and use that money to fund developers. So that could be a bad sign, so you have to watch out for that. Next point, here's an example of one of the best treasuries in all of the crypto market. This is from Near Protocol. This is a little dated, but that's not important. What's important here is that you can see, number one, that Near Protocol has a lot of money. They have one of the highest treasuries. And the second point is that not all of their treasury is in their native coin. That's extremely important. So if their native coin, I should say, goes down in price, they don't need to worry. They can just use dollars. Because if you look at the bottom right under fiat, they have $349 million as of June 23 in US dollars in stable coins. Basically, most of it's in US dollars. So that is excellent. That's what you want to look for in a treasury. And again, you rarely see this in any treasury. Factors affecting tokenomics have to do also with the utility. Is there a utility and use case for the coin? And is there an adoption curve? Are there many dApps adopting the particular blockchain? Of course, I'm going to talk about Solana because Solana is the hottest thing since sliced bread. Solana started out as being a blockchain for DEXs, basically. Something like the NASDAQ. Totally was trying to improve speed, so he came out with Solana. Anatoly Yakovenko, remember, guy out of Qualcomm, brought his Qualcomm colleagues over to Solana Labs, and they worked on this fast protocol. And then Sam Bankman-Fried got involved in FTX and Alameda, and they nearly destroyed Solana. Remember, Sam Bankman-Fried got involved with Solana because he liked the speed. He wanted Solana to be basically his decentralized exchange. Because remember, Sam Bankman-Fried had a FTX, the centralized exchange, and he wants Solana basically to be the decentralized exchange / blockchain. But now Solana has many use cases, NFTs, and what's very big now is DePIN, decentralized physical infrastructure. And you can see here on the left side, we've got Render, which does like drawn, digital drawn and NFTs. You could do that for gaming. And then you've got Helium, which is for hotspots in mobile, basically a replacement of your expensive Verizon and AT&T cell phone service. And of course, you have Hive Mapper, which is a replacement for Google Maps. So this is a very hot area. So it's a very high use case for Solana. So that means Solana's native coin, Sol, is going to have high natural demand. And that's been very important, organic demand. And this is the vesting schedule for Near Protocol. And I said earlier when I showed you those bullets of what's important for tokenomics, I mentioned that the vesting schedule is extremely important. Well, if I didn't, I'm doing it now. So as I mentioned earlier that whether or not there's a supply, whether or not the maximum, the total supply is high versus circulating supply, that's important. But what also is important is whale risk and this. This is the vesting schedule. So if you have high whales, like let's say 50% of your ICO goes to whales, to insiders, and then you have the steep vesting schedule, which shows you the amount of coins that can be unlocked over time. So when it's very steep, it means that coins are being unlocked rapidly, and those insiders can sell. So when you have that, that's a big no-no. So I sound like I contradicted myself because I said Near is one of the best blockchains, but I also said that Near has a very steep vesting schedule. But here's the good news. That vesting schedule is nearly complete because we're beyond the 36-month schedule. So 36 months is right here where my pointer is. So we're beyond that. So now the vesting schedule went up quickly. So as I said, it went up quickly. Now it's flatlining. That increase you've seen is just basically, trying to remember what it's called. It's basically inflation, things like that. It's not insiders dumping and unlocking of that. So it's a very good thing that you have like normal inflation. It's still pretty high, around 5%. But the dilution is gone. It's almost nearly gone. So it's very good. So always check what the vesting schedule is, and you can get that. I'm going to say later on slide, but you can get that in the white paper. And there's going to be a slide explaining that, like where to get all this information. Factors affecting tokenomics is the token unlocks, and this is intricately related to the vesting schedule, because you have more unlocks quickly, you're going to have a steep vesting schedule. So these are the ones, according to token unlocks, that have the highest remaining locked value. So the worst is XRP, Filecoin, Optimism. So one key point that you should know that's not obvious from here. If you look at the bottom here, Gala looks like it has the lowest amount of token unlocks, but you need to compare that with the total market cap. So if Gala has a market cap of $500 million and have another $500 million being unlocked, that's 100% inflation. So that's very bad. So just be careful of that. You have, like I said, you have to look at it all together, holistically. So here's a great example. You can't just look at this chart and say, oh, Gala looks good because it only has 0.5 billion versus XRPs that has 18 billion unlocked. You cannot do that. Inflation schedules. I like inflation schedules that are going down. Near's inflation schedules is basically about 5% flat line, and then it goes down after it reaches something like 1 billion transactions. But I like this one here, this from Solana Labs, because it gives you a carrot. It gives you a motivation. So it started out at 8%, but it's rapidly declining. So that's what you want to look at. You want to see an inflation schedule that's basically a schedule. It's going down. So it gives you hope. It gives you hope that there's going to be lower and lower dilution going forward. This is the website and chart I think you should all know, be aware of. I'm sure many of you know this. This is Ethereum's burn. And it's from Ultrasound Money, and everyone goes on it all the time to see if Ethereum is like Bitcoin. And it turns out, yes, it is like Bitcoin, because Ethereum, believe it or not, it actually has lower inflation than Bitcoin. Bitcoin has 1.8% annualized inflation, which is going down to 0.9% during the next halving, which is going to be in April of this year. But right now, as of today, Ethereum has flat inflation. It actually has slightly negative inflation. So it's a very good coin to own if you're worried about the debasement of the US dollar. It's almost as good or as good as Bitcoin. The reason I say it's almost as good, even though Bitcoin has high inflation, is because Bitcoin's narrative is that it's a safe haven and it's a hard currency. So its use case is basically digital gold. Ethereum's use case, as you know, is DeFi and things like that. Factors affecting tokenomics also include staking. If there's a lot of staking and for a long period of time, that's good, right? Because you're locking up your coin. And this is an example of coins, of projects that do not have high staking. Because, for example, Kava's staking is 13.3%. That's really low. We want staking of 60% and higher. And you want a lockup that's at least 2 weeks or higher. Tokenomics for specific projects. Again, you can stop this and print this out. There's a lot to say here. I'm just going to go over a few of them. XRP/Ripple, it feels like a pump and dump, has huge inflation and a lot of control. I shouldn't say a lot of control. It is controlled by the for-profit Ripple Labs. Filecoin, too, has a huge amount of inflation. And I'll give you a shortcut, but again, this is only a shortcut. You have to look at each project individually and look at the details. But here's a shortcut. You compare the total market cap as of today with the fully diluted market cap. And then you can so here, and for Filecoin, it's $10 billion for fully diluted market cap. Then you divide that by 2.5, you get about 300%, and then you can divide that by 10, assuming, and this is why you need to look at the details, you're assuming this dilution is going to be within 10 years. And so you take 10 billion divided by 2.5, you get 300% inflation, then you divide that by 10, and you get 30% annualized inflation, which is used. Again, that's a heuristic, right? I don't know if you know the word heuristic. It's a back of the envelope way of calculating inflation. But the proper way, if you're looking at a project and doing a deep dive, the proper way is to go, what I said earlier, is look at the vesting schedule. Because maybe the vesting schedule stops after 5 years. So what you have to do, if it stops in 5 years, you take the market cap, divide by the fully diluted market cap, divided by today's market cap, and then you divide that number by the vesting schedule in terms of years. So in the case I just mentioned, it's 5. So always look at what the vesting schedule is. Is it 10 years or is it 5 years? So most of them are about, I guess, like 5 years, something like that. Well, the steepness is usually within the first year, the steepness of that curve. So that means you should always, always, always be careful of new projects, new ICOs, especially those layer 2s, because those are new projects. So let's get going. I mentioned Pyth already. Algorand, here's something specific to Algorand project, which is very, very bad. They had not just a steep vesting schedule, they had an accelerated vesting schedule. That accelerated vesting schedule allowed insiders to sell and dump their Algorand when the price reached a certain level. So that was really bad. That's why Algorand, that price went down dramatically. I think it went down like 90% or more from its high. Cardano's the case we have a good tokenomics because they have a very high, well, not very high, but high circulating supply. However, I don't know if we should all trust Charles Hoskinson. He's a very controversial guy, I should say. And there has been some patterns in the chart of pumping and dumping. There is some whale risk with Cardano, but again, they have a decent tokenomics in terms of circulating supply. Multiverse also has a very good to very good circulating supply. They have a 84.5%, you can see here, of circulating supply divided by max supply. However, they too have their individual issue because they rebranded, they changed the name. They used to be on Binance, I think on Ethereum. So basically, they're coins that have not been converted yet. So there might be more coins that haven't been converted from the old ERD to Elrond, or I should say Multiverse X. All these name changes. Ethereum we mentioned is very good. Engine looks very good superficially. And here's something you should really look into. Here's something no one talks about. So Engine looks great. There's a max supply limit. I think the circulating supply is high. However, because they had that max limit, they couldn't issue any secondary sales on coins. So what they did is they circumvented that. They went around it like a loophole, and they ICO'd another sister chain called Infinity, and that added supply. So you have to be careful. And in a related matter, there's layer 0 chains where you have to be careful, because those chains like Avalanche, Cosmos, and Polkadot, some of them look very good superficially, but they allow other tokens to be used on their chains. And of course, there are other chains like Solana or Ethereum that allow this too, but it seems to be a worse problem for layer 0s when they allow other tokens on the chain. It lowers and reduces the use case for that chain. You see what I'm saying? Like some chains, I'm trying to give you an example, like Cardano, I believe it's just Cardano, no other tokens. So you have to use Cardano's token. So that's good for tokenomics. So I promised you I would give you information on sources of information to get all this detail on tokenomics. So you can go to project white papers, for example. White papers have information on the vesting schedule. You can go to the foundation, the blogs, the ether scans, explorers of each project. You can use, now what's more popular is that you can use secondary research companies, but they charge money sometimes. Token Insights, Masari, Token Terminal, data websites like Token Terminal, Stake.us. You can go to tokenunlocks.com, or you could go to a website called Money Printing. Final thoughts. Sorry I went through this quickly, but there's a lot to say. Like I said, you could just print them out and highlight them. That's what I would do. I would review this again. So what are my final thoughts? I said this earlier. I'm going to say it again. Look at these projects on a holistic basis, all in. Look at everything, all encompassing. Don't just look at tokenomics. And even within tokenomics, look at everything. That's the most important thing to think about. And once you've done look at these projects, walk away and come back and see how you feel in your gut. How does it feel? Do these projects feel authentic, or do they feel like they're short-term oriented? We want projects, I should say, not companies. We want ones that are long-term oriented, that they may have inflation, they may have a lot of coins, but they're trying to design good projects. And I think a good example of this is Polkadot. I gave you quite a few negatives. I said that they allow other coins to be on their projects, and that's not a good thing. And I didn't say this about Polkadot. I don't think I did, but they have somewhat high inflation. But the positive about Polkadot is they're really well designed. Gavin Wood is a really good mentor to listen to. He was a chief technology officer of Ethereum, and now he's a founder of Polkadot. So he's a really good mentor for this space. And I think Polkadot is just, like I said, designed well, and they're just very thoughtful about everything. So is there a use case for them? No, hardly anyone's using Polkadot, but it doesn't mean it's a bad blockchain. It just means that maybe that time hasn't come. So like I said, you have to just walk away sometimes and then come back and see how these projects feel deep down, because there's a lot of different factors to look at. And my last point is always analyze a blockchain. Oh, I didn't mention this to you earlier. Always analyze a blockchain on a relative basis, meaning, compared to other layer 1s or layer 2s, but not just that. What's their stage? What's their growth stage? Did they get started 5 years ago, or did they get started 5 months ago? Because if they got started 5 months ago, of course they're going to have a steep vesting schedule. Of course they're going to have a lot of venture capitalists involved with them that may dump. So you have to look at the projects just like people. Analyze them according to the circumstances then prevailing. That's very, very important. Well, thank you all for listening. And remember to like us and smash that subscribe button, because if you want to see more of these videos, that helps the algorithms or whatever those, who knows what's going on with the black box of YouTube, but it helps me get more coverage, and then I can produce more videos. Thank you and goodbye.